Hello, my friends! As many of you know, this channel is all about food, fun, and finance. Food feeds your stomach. What's as important to know is that finance feeds your brain, and that knowledge will help put more money into your back pockets. Today, I have Ling here who is going to share with you her knowledge on 401ks. Many of you may know what a 401k is. Some of you even participate in a 401k. Trivia question time. What types of 401ks are there? You may be thinking, what do you mean, Hot Pot Bob? Well, I'll give you another minute. Most of you may not know the answer to this. Well, after watching this video, all of you will know the rest of the story. Ling is going to go over what a 401k is, what are the three types of 401ks, what are the tax advantages of each one, and what are the drawbacks of investing in a 401k. Also, stick around and near the end of this video and she will share with you a bonus knowledge session on what is a company match and which of the 401ks does that employer contribution actually go to. If you haven't already done so, please hit the subscribe button, click the bell for notifications, hit the like button, add a comment below. We greatly appreciate it. Let's go!
Thanks, Hot Pot Bob, for your great introduction. I also thank everyone for your support and hope you find these videos helpful. Let's first cover some basics of 401k. 401k is offered by your employer as workplace retirement savings plan. They are not obligated to offer this benefit to you. So if they do, you may want to look into the detail and decide whether this plan is beneficial for you or not. 401k plans offer tax advantages, which we will be diving into shortly. IRS has rules regarding the contribution limit for the year. You do want to understand what that limit is so that you can plan accordingly. In general, once you elect to contribute to 401k, the contribution will be taken out directly from your paycheck. Once you understand the annual contribution max limit, then you can calculate how much you would like to contribute to your portion of the plan from each of the paycheck. The employer gets to decide which administrator or provider to use to manage the plan, and the common ones are Fidelity, Vanguard, and T. Rowe Price. Once the plan has been established, it usually offers a list of investment options. You as the employee can choose from the investment options that best fit your investment needs. Some employers also offers a company match, and usually there are some conditions that you need to meet before you can get awarded this match. There are usually two common conditions. The first one is vesting schedule. What that means is the company decides that you need to work for the company for X number of years before you can be awarded the company portion of the match. The second condition is before the company will match a certain percentage to your plan, you also need to contribute a certain amount towards your 401k. Now, for these two conditions, there's not any universal policy that all company follows the same rule. It really varies from company to company. One thing to keep in mind is the company match can only go into the traditional 401k account, even if you contribute to Roth 401k. For those of you who's currently participating in a 401k plan, please feel free to share your vesting schedule and also company match percentage so that we can share the detail with this community. Let's talk about contribution amount next. Earlier, we mentioned that IRS has a contribution max limit for the year, and this is adjusted to account for the inflation. This amount can vary from year to year. For the current year 2022, if you're younger than 50, let's say you decide to contribute only to traditional 401k, then you can contribute up to $20,500. If you decide that you only contribute to Roth 401k, you have the same max limit of $20,500. But if you decide that you wanted to contribute a portion of your money to traditional and then the other portion in Roth, your combined contribution cannot exceed $20,500. Same concept applies. If you're 50 or older, you can contribute additional $6,500 to a max of $27,000. Let's dive a little bit deeper to compare traditional versus Roth versus after-tax 401k. First, let's talk about traditional 401k. Your contribution are pre-tax money, which means you have not paid any taxes. And the contribution can also use as deduction on your tax return to reduce your taxable income. At a time of withdrawal, that's when you pay all of the taxes. Let's take a look at this example. Assuming you make $100,000 gross income and you contribute $20,000 to your traditional 401k. You can take the $20,000 contribution and deduct from your gross income. You will end up with $80,000 taxable income. From there, you will pay the taxes based on your tax bracket. Using the same example, if you decide to contribute to Roth 401k, your Roth contribution are after-tax money. Therefore, at the time of withdrawal, you don't need to pay any taxes at all. So the math will look like this. Same assumption that you make $100,000 gross income. You will pay your taxes first. If your tax bracket is at 15%, then you pay the $15,000 in taxes. You will end up with $85,000 net income, and minus $20,000 401k contribution, what you end up in your pocket for that year is $65,000. There are some companies that offers after-tax 401k. You can contribute a substantial amount into this plan if your income allows you to do so and if your company offers this plan. I will have a separate video to talk about a strategy that leverage after-tax 401k to save up to $60,000 in the retirement account, as well as how to convert to a Roth so that you don't have to pay any taxes at the time of withdrawal. I'm curious exactly how many company out there actually offers after-tax 401k. If you do have such plan, please leave us a comment. For now, just so you understand how tax works for after-tax 401k, the contribution are after-tax money, similar to Roth. And the difference between Roth and after-tax is that for after-tax 401k, when it's time for withdrawal, you will not need to pay any taxes on the contribution portion. However, you will need to pay tax on the earnings that you made from the investments. To summarize, for a traditional 401k, your contribution is tax deductible, which can be used to reduce your taxable income. And the earnings in the account is tax deferred, which means you don't need to pay any taxes while you're accumulating this account. At the time of withdrawal, the withdrawal amount will be taxed at the ordinary income tax rate. For Roth 401k, you're using after-tax money for the contribution, and therefore the funds can grow tax-free while you are accumulating. And at the time of withdrawal, you also don't need to pay any taxes at all. For after-tax 401k, you're using after-tax money for the contribution. The funds can grow tax-deferred, which means while you are accumulating, you don't need to pay any taxes. But at the time of withdrawal, there are two portions of the money. The contribution portion, since you already pay tax, then you don't need to pay tax anymore at that time. But any earnings or gains from the investment, you will then need to pay tax at the ordinary income rate at that time. What are some of the drawbacks of a 401k? First of all, you can only start taking withdrawals when you turn 59 and a half or meet other totally disabled criteria. This is intended for a retirement fund. That's why you can't really touch the money until you are 59 and a half. If you happen to need money before the qualified age and start taking withdrawal, there are 2 tax liabilities you have to keep in mind. Number 1 is the 10% early distribution penalty, and number 2, if your investment has returned any earnings or gains, you will need to pay tax on those earnings. To avoid the penalties and the tax liabilities, check with your specific plan to see if your employer offers loan options, and that might be a workaround. The last point is, after you turn the age of 72, if you have not started taking the money out of your 401k account, you will need to, and that is called required minimum distribution. The specific percentage amount is determined by IRS. That may not be a bad thing after all. The whole purpose of having the 401k account is to save up so that we can enjoy our fruits of the labor when we retire. Just one thing to keep in mind and plan ahead of time. In case any of your RMDs require you to pay taxes, you can then set aside a portion of the money to account for that. The last topic is company match. We talked about earlier, the company match portion, there are usually 2 conditions. One is vesting schedule. Another one, the company may require you to contribute X dollar amount to your 401k first before the company will contribute their portion. We also talked about the company match portion will always go into your traditional 401k bucket. And since you have not paid any taxes, at the time of withdrawal, you will need to pay the tax on the company match portion as well as any earnings or gains that you made from the investment. Regarding the contribution amount, we talked about earlier that as employees, we have a max contribution amount of $20,500 for this year of 2022. The company match portion does not count towards $20,500. However, there is a combined max contribution amount. For this year, that max cap is $61,000. For the most part, the company match is not a huge amount, so I don't think any one of us would really have any concerns of going over the combined max cap of $61,000. The last point about converting the company match to Roth 401k is that since you have not paid any taxes, that will become a taxable event of the year that you decide to make the conversion.
Thank you, Ling, for sharing your knowledge related to 401ks and its features and benefits. I hope all of you enjoyed watching this video. If you found this video helpful, please make sure to subscribe to this channel, hit the like button, and share with anyone who may also benefit from this knowledge. See you all very soon. Bye.